Hello and welcome to this session. This is Professor Farhat, in which we would look at the time value of money, and I'm going to call this session for capital budgeting purpose. What does that mean? It means I'm teaching you this concept, time value of money, specifically present value of a dollar, of a single payment, and the present value of an annuity. Now, there is no such a thing as only for capital budgeting purpose. I am telling you it's for capital budgeting purpose because I do have time value of money covered in details in my other courses, in my intermediate accounting course, as well as my CPA courses. So for this session, it's specifically focusing on the present value. I just want to make this clarification at the beginning in case you wonder why I did not cover the future value of a single payment, the future value of an ordinary annuity. The purpose is we are focusing on the present value computation. Let's start to focus on the explanation. I'm going to start by saying a dollar received today is not the same as a dollar received a year from now. It's not the same. So it's the same dollar today. It's not the same if we're looking into the future. Why? Well, there are many reasons. The first reasons we should all be feeling now and that's inflation. And what's inflation? You are losing purchasing power. I'm going to give you a true example, which has happened with me recently, and that's a Wawa gift card. One of my viewers, like yourself, I help him pass the CPA exam, and I always give examples about a place called Wawa. And he gave me a gift card for $100. He gave it to me December 16, 2021. He gave me this card. I was going to Florida. I forgot to use it to fill out my car with gasoline. Then I just forgot about the card altogether. 6 months later, this $100 card, which is worth $100 when he gave it to me December 16th, it's not the same as today. Back then, I'm just going to give up some, use some numbers. And the reason I know this is because when I went to Florida, so just let me tell you how many gallons I could have purchased. The gasoline was approximately $3.50. So with that money, I could have bought, so you will see the effect of inflation, around 28.5 gallons of gasoline. Recently, I went to Michigan. If I wanted to use this $100 gift card to purchase gasoline from Wawa, the average price when I was up there specifically was $5. So now I can only buy 20 gallons of gasoline. And the same concept would apply to coffee, so on and so forth. Simply put, the $100 that I received on December 16th, it's not worth $100 today, which is only 6 months later. The point, it was eating by purchasing power. So there is a time value to the money. And this is an example. The other example is risk. If someone asks you, would you receive $1 today or $1 into the future? Well, if you're going to wait for that individual to give you $1 in the future, you are taking a risk. So you want to be compensated for that risk. You would say, okay, either give me $1 today or $2 into the future. Now you are willing to wait if you think your risk is worth $1. So simply put, $1 today is not worth the same. Although there is no inflation, there is no eroding of your purchasing power, nevertheless, that individual may not come back and give you that $2. So $1 today in your hand, better than a promise of $2 because we have risk involved. So keep that in mind as well. We have risk, that's why they are not the same. The third reason is you can invest this dollar. If someone gave you $1 today, you can invest it and you could have more than $1 a year from now. Or you could have less, you could lose it all. The point here we're trying to stay positive is you can invest this money. So when we are comparing money, and this is an important concept in this capital budgeting purpose, when we compare money in the same time period. So we cannot compare money. We cannot say year 3 we have $100 and year 1 we have $100. Those two $100 are not the same because they live in two different time periods. We have to bring them to the same time period, which is bring year 3 to year 1. Now we can compare year 3 money to year 1 money, or we can move year 1 money to year 3 money and compare them. Well, how do we do that? This is what we're going to be learning, the concept of time value of money. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Let's start illustrating the concept by working a simple example. Assume Bank of America pays 10% on $1,000 deposit made today. I hope we're not going to get to that point, Bank of America paying 10%, but the way inflation is going, we can get there, but I hope not. How much this money will be worth 1 year from now? I'm pretty sure all of you already know that we're going to have an additional 100, therefore we're going to have 1,100. But let's clarify, let's illustrate the formula because we could have multiple years. The formula is as follows. F is for the future value of money equal to the present value times 1 plus R. R is the interest rate raised to the nth power. How many periods? So N is the number of periods, R is the interest, 1 is the original amount, which is whatever amount we have. We have to multiply the present value times 1 plus. P is the amount invested today, which is the amount invested today is $1,000. And F is the future value. If we plug in all the numbers, 1,000 times 1, again, why do we add 1? Because we want to have we want to keep the initial amount, the principal amount, plus 10%, 0.1 raised to the first power. Therefore, the future value of this amount is 1,100. So as an individual, if you have $1,000 today, okay, this is what we are saying. If you have $1,000 today, and if you believe Bank of America is paying market rate, and someone asks you, will you accept a $1,000 today or 1,100 a year from now? For you, it doesn't make a difference. Why? Because the $1,000 today is a $1,000 today, and a year from now, $1,100 is equivalent to you because you are waiting a year. You are being compensated for that wait. Now, what if we left the $1,100 in the bank for a second year? How much the original 1,000 will be worth at the end of the second year? Now what we're saying, let's keep it for 2 consecutive years. Keep that money. Well, after year 1, we're going to have 1,100 times 1 plus I raised to the first power, which we will have, most students would say 1,200, which is not correct. It's 1,210. Why? Simply the formula, if you really want to go with the whole formula, the future value equal to 1,000, if you want to use the formula, plus 0.1 raised to the second power. So what we are doing here is we are compounding, and this is an important concept in finance. We are compounding the interest. So 1 plus 1 raised to the second power, this is called the compounding factor. So we are doing it for 2 years. But what I did here is I told you, let's keep the money and plus the interest that we earned, which is the $100, and keep it for another year at the bank, we will get 1,210. You might be saying, why not 1,200? The reason is because the additional $100 stayed at the bank, and this additional $100 for year 2 earned you another $10. And this is called compound interest. We have compound interest versus simple interest. So when you invest, when you put your money in the bank, or when you borrow money on your credit card, you have to understand how you are being charged. Are you being charged or are you being rewarded using a compound interest? If you are being rewarded, you want it to be a compound. You want your interest to earn interest. Or they are compensating you using simple interest. Simple interest where once you made this $100, they will send it to you and you'll keep the $1,000. So only the original amount is making profit. Now, when you have a credit card, well, that's bad. In most credit card in the US, it's a compound interest. So they will charge you interest on the interest. Okay? But again, if you want to learn more about this, go to my finance course. This is not the course that we need to look for. Now, looking at this formula here, okay, the future value equal to the present value 1 plus R raised to the n. We can rearrange this formula, and basically if we want to find the present value, we can say the present value equal to the future value 1 plus R raised to the nth. Now in your textbook, they may call the RI, which is the interest. It doesn't matter, it's the interest factor. What I'm trying to say is this. We can look at the present value and the future value as the same. So the present value and the future value, they're basically the same, because remember, they should equal to each other in terms of value. We can use the same formula. So let's find out how we can compute the present value. I showed you the formula, but let's apply it. If a bond will pay $1,000 2 years from now, What is the present value of the $1,000 if an investor can earn a return of 12%? Here's what we are saying on a timeline. This is year 0, this is year 1, this is year 2. Someone came to you and said, look, I'm willing to give you $1,000 2 years from now. Now, 2 years could be 2 periods. The period could be a quarterly, but here we are assuming years to keep it simple for capital budgeting purposes. So year 1, year 2. How much will you invest today? So in 2 years, you will receive $1,000 and you are happy with that. Now you already know you want to earn 12%. So what you do now is you use the formula and you will discount. You would say, okay, my future value, I know I want $1,000 2 years from now. If I divide $1,000 by 1 plus r raised to the nth power, my interest rate is 12 raised to the nth power, that's going to give me a present value amount of $797.20. We call the 12% the discount rate. Now, how do we come up with discount rate? So I'm talking about the real world. How do companies or investors come up with the discount rate? This is what you want to earn. What does that mean? It's mean based on your risk tolerance. If you want to earn more, if you want to take more risk, you would earn more. If the investment is less risky, you would command lower rate of return because the investment does not require. So the higher the interest rate, the riskier is the investment. That's what I'm trying to say. But in the real world, you will determine this based on your risk tolerance, based on your time horizon. How long are you willing to wait? Now, this process is called discounting. So we have discounted the $1,000 to its present value. Let me just show you the math. This way hopefully you'll be more comfortable with this idea. So if you invest the money today, $797.20, and you let it grow at 12%. Simply put, you said, well, I want it to grow at 12%. If we take this amount multiplied by 12%, not 1.12, just 12%, you're going to earn $95.66. At the end of year 1, you will have $892.86. If you keep this money for year 2 and you let it grow at 12%, it's going to earn you $107.14, and in 2 years you will have the $1,000, the amount that you were promised and the amount that you wanted to earn based on your risk, based on your market rate, based on your discount rate, which happens to be 12%. Now this is how we can do this, but think about if you have an investment that's going to be there in 5 years or 6 years or 12 years and the interest rate is, I don't know, 6%. So we can change this. Mathematically, it becomes cumbersome to compute. Now, in the real world, you could use Excel, you can use software, but in college courses on the CPA exam, you need to know how to use something called the time value table. This is a time value table. This is the time value, the present value of a single payment or the present value of $1. And what happened is this. You're going to have these tables. You're going to have the periods and the rate. And what you do is this. You would say, if I want to find the present value of $1,000, the periods, 2 periods. Now, we're assuming the periods are years. The periods could be other than years. I'm emphasizing this point because to really learn about the time value of money, you have to go to my time value money lectures and my intermediate accounting, the more advanced, or to my finance course. But this is good enough for now. 2 years from now, earning 12%, the factor is 0.797. So if you take the $1,000 times 797.2, which is just rounding, and your tables might look a little bit different. So the present value is $797.20. So simply put, I showed you how you could compute this by looking at the tables, by being able to read the tables. And this is an example of the tables. This is the formula, the present value equal to 1, this is the future value, divided 1 plus r raised to the nth. Now your table might look a little bit different, but this is the period. So I can find the present value of any amount, 8 periods, 10%, that's the factor. 11 periods, I don't know, 17%, so on and so forth. So this is how you would use the table. Now we're going to work an example just to to practice this table. But before we work an example, I would like to remind you, most likely this is who you are, a student or a CPA candidate. Go to farhatlectures.com where I have additional resources, lectures, multiple choice, true-false exercises that's going to help you with your CPA review course as well as your accounting courses. If you have not connected with me on LinkedIn, please do so. Take a look at my LinkedIn recommendation. Like this recording. The mere fact that you are watching, it means it's helping you. Like it. It will help others. Connect with me on Instagram, Facebook, Twitter, and Reddit. Let's take a look at this example. How much you would have to put in the bank today to have $1,000 at the end of 5 years, 10% interest. Okay, let's look at a timetable here, at a timeline here. Today is 0, 1, 2, 3, 4, 5. You're going to have $1,000 5 years from now. How much will you invest today? That's the question. Assuming you want to earn a 10% interest rate. Now, one way to do it is to take the 1,000 divided by 1 plus I, 1 plus R. I always use I because when I learned it initially it was I. 1 plus R raised to the second power. R is 10%, not the second power, the fifth power, and you will find the answer. Or most likely you would not have to do so unless you're in a finance course, and if you are in a finance course you'll have to input everything in your financial calculator. You need to learn how to use this. For capital budgeting, you're going to have to use the tables. Here what we are looking at is 5 periods. We are looking at 10% rate of return, and the factor is 0.621. So if you take $1,000 times the factor 0.621, we find out that the amount you will need to invest today is $621. If you invest this money today and you let it grow for 5 years, it will give you this amount, and let me show you. I did put it here to prove the math. So 621, you multiply this by 1.1, 10%. It's going to grow to 683. You'll take the 683, you keep it in the bank, you multiply it by 1.1. It's going to give you 751. You multiply it by 1.1, you multiply it by 1.1, you multiply it by 1.1, and in 5 years you will get the amount that we said you will get, $1,000. $1,000. Again, what we did is we computed the present value of one single amount, which is good. That's something you need to know. But that's not the only thing you need to know. You need to find the present value of a series of cash flow, which is called an annuity. What is an annuity? An annuity is when rather than receiving $1,000 once, okay, you might have to receive the $1,000 once, twice, 3 times, 4 times, 5 times, 6 times, okay? And this is very common, 3, 4, 5, 6. For example, when people retire, when they're close to retirement, what they do, they sell all their stocks, their bonds. They usually liquidate any real estate investments they have, and they put all the money in an annuity. What is an annuity? So they will pay an amount here, and they would say, we want to receive for the next, 20 years, the same amount every month. It's called an annuity, okay? So, also, for capital budgeting, what's going to happen is this. You might have to either pay, or usually you would either pay, means you're going to save some money, or you're going to receive additional income from undertaking a project. And that income, it's going to be the same every period. So, you want to know how much is the present value of all these payments. Now, you can take each one separately and discount them as we just learned, each one separately. For example, if this is a 5% discounting, you would say, okay, period n equal to 1, r equal to 5%, and you will do this $1,000. N equal to 2, r equal to 5%, and you will discount this $1,000. N equal to 3, r equal to 5%, so on and so forth. But this is really time consuming. Obviously, in the real world, you can use a calculator, financial calculator, Excel, or a software. But for my purpose, for the purpose of capital budgeting and a managerial accounting, cost accounting, CPA exam purposes, you need to know how to find the present value using a table. And this is a present value of an annuity table. So in your textbook, you're going to have the present value of a dollar, which is a single amount, or the present value of annuity. Now, also, you have to be careful. You have 2 types of annuity. You have ordinary and you have annuity due. For my purpose, we don't cover annuity due, which is basically, I'll explain what it is, but just be careful in your textbook, depending which textbook you are using, whether you are looking at the ordinary or annuity due. And let's work an example to illustrate this concept. Adam purchased an equipment on which a $60,000 payment will be due each year for the next 5 years. So this is what it looks like. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. And what Adam says, Adam's going to make payment on this asset, on this equipment. $60,000 60,000, 60,000, 60,000, and 60,000. Now we want to find out what's the present value of this annuity discounted at 10%. Well, as I said, we can take each 60,000, we can take each one of these 60,000 and find the present value separately. Or we can go to the present value table. We know we are dealing with a five payments. We know the interest rate that we are commanding is 10, which is 10 right here. 5 and 10, they intersect at the factor 3.791. Well, that's easy. Now, all what I have to do is take 60,000 times 3.791, and the present value of the payment is 227,460. And as I said, this is an ordinary annuity. What is an annuity do? An annuity do when Adam needs to pay the first 60,000 today, year at point zero. 60,000, 60,000, 60,000, and 60,000. So again, we have 5 payments of 60,000. However, the first payment is due immediately at point zero. Under those circumstances, you will have to use the present value of an annuity due or manipulate the formula. I'm not going to go into the manipulation here. I go over it in my intermediate accounting because, again, I'm going to keep this simple because it's for capital budgeting purposes. So you would use the annuity due formula. Now, also in your textbook, you're gonna be giving a present value annuity table. Remember, you have to be very careful. This is OA, ordinary annuity. Again, you're gonna have the periods as well as the rates. So you have make sure you are using the proper table. It could be a present value of a single amount. It could be the present value of an annuity. Well, let's work an example to see how this all fits together. If the interest rate is 6%, how much you will need to put in a bank account today so you'll be able to withdraw 1,000 at the end of the next 5 years. And another usage of this is when parents send their kids to school. For example, parents plan, they would say, okay, we would like to have for our kid to be able to take out, I was going to say 40,000, tuitions are just getting out of control. 40,000, and let's assume they have CPA 5-year program, 40,000. So 1, 2, 3, 4, 5. So let's assume parents want to make an investment today. Today they want to make an investment, and they want the investment to pay them. Simply put, they want to be able to withdraw $40,000 for the next 5 years. So they pay the tuition for their kids, or they want, they want it to, they want to live off it. It doesn't matter. Okay, so how do we find this? Well, again, we can find each $40,000 separately, or we can go to the present value table, 6%, 5 periods. So let's go to 5 periods. This is 5 periods. I'm using different colors here. 5 periods, 6%, and the factor is 4.21236. Okay, so we're going to take the 1,000 times that factor, 4.21236. We're gonna round, and it's gonna be 4,212. Just gonna ignore the 0.36. In your textbook, they might go, depending on how many decimals they round. I did not do it. So simply put, if you want to make an investment today, let me show you this on a timeline because let's use the numbers that we did here. This is 5 years. You want to take $1,000 per year out, 1K per year. How much will you pay today? If you put an investment for 1,212 and that investment is paying you 5%, you'll be able to take $1,000 every year. And let me prove it. This way you can see what I'm talking about. You go to the bank today, you will deposit 4,212. You will wait for a year. This money will grow at 6%. So it will take this amount times 1.06, and it will give us, at the end of the year, we will have $4,464.72. We will take the first 1,000 out. We'll withdraw the first 1,000. So the balance at the end of the first year will be $3,464.72. We let it in the bank account. It will grow again. This amount will grow at 6%. 6% means you will take this amount times 1.06, and it will grow to 3,672. You will take the 1,000 out. Now you have the new balance. It will grow at 6%. You will take the 1,000 out, and you keep doing this for 5 years. At the end of year 5, after you take the last 1,000, your balance will be 0. The point is, I'm trying to prove the math for you that it will work. This is the value of this investment. 4,214. Now this is, I explained the time value. I explained how to find the present value. Is this good enough? Well, it's good enough to start, but what you need to do now, go to Farhat Lectures and work MCQs, because all this information that we learned today is needed for the capital budgeting, which we're going to be work with capital budgeting in the next session. So that's why I'm doing this. That's why I'm explaining the time value now. So when I'm covering capital budgeting, I'm going to say, you know how to discount, and I'm going to take that for granted. Anyhow, at the end of this recording, I'm going to remind you to study hard, invest in yourself, invest in your career, and of course, stay safe.